Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 82. As always, jumping the three amigos. We got Rich Diaz of Acorn and Macro Consulting, Keith Dicker of IceCap Asset Management. The Don, he's back in the blue room.
Me? No, Keith.
Am I the blue room?
Yeah.
Are those your mom's glasses?
So people who are listening and not watching, I had to go to the optometrist yesterday. So they had to dilate my pupils. You ever get that done? And then when you leave, they give you these huge, like Arnold Schwarzenegger Terminator glasses to wear outside because it's so bright. So I go for, I'm going to do an experiment here. So I go to the coffee shop with these things on, and I'm thinking, what's the reaction going to be? And this is a compliment to, today's society. I go in there and, oh my God, people, first of all, they thought I was blind. They're trying to help me through the place. But everyone's super nice to me, talking to me. And I'm thinking, back when I was a kid, if someone did this, they would be kind of like dork, nerd, geek. There would have been no one helping out. But anyway, I did get through the optometrist meeting, and I'll have new glasses coming up pretty soon. But that's the start of my week.
You're going to be a new man.
Rich, maybe you go borrow these if you go on a date sometime. Yeah.
Well, I could do, but for me, how am I doing? Well, today is the best day of the year. It's May the 4th. Be with you. It's Star Wars Day. Yes. It's Star Wars Day.
Total geek alert here, right? Just really.
We're going to switch things up today. We're going to spend the entire hour talking about which is our favorite character from Star Wars. No, we're not going to do that today. No, Star Wars Day. That's the only thing I have to say. The other thing is Canadian icon Gordon Lightfoot died. And he's very popular. I'd never heard of his music, really. I know we're meant to all love him because he's a Canadian icon. So I spent the whole week going through his Spotify album, and I really don't like his music. It's very boring, but he is a Canadian icon. So I figured like that. That's right. Keith and Gordon Lightfoot went to high school together, so I'm sorry, Keith, about that. But yeah, so there you go. That's all I got to say. Otherwise, it's loads of good stuff to talk about today. So there you go.
Wow.
Well, I do remember we're in school. We actually learned the Lightfoot song, the wreck of the Edmund Fitzgerald. Did you guys do that?
Yeah.
Really?
Yeah.
I'm impressed. That's good.
Of course.
Yeah.
It's
Steve is like deer in headlights right now.
Yeah. No. I had no idea what you're talking about.
Yeah. Have you heard of the Tragically Hip? Do you know those guys?
Yeah.
Okay. We're getting a bit closer.
Tunes.
Tragically Hip.
Big in the hockey room.
That's right.
Well, I mean, we've got, quite a bit to get through this week. We've got some updates from several central banks, including the Fed, of course, which we'll get into. Some news from TD Bank, of course, the housing front as well. Getting a lot of questions about what's going on in that front. Just got back from Myrtle Beach, where we blew some heads there on about the Canadian housing market. I just gave a
you did what?
To a whole bunch of Americans, and that's going to be a tough. Someone have to edit that out, eh? Just gonna have to edit that out.
Where'd you go? We go.
Where'd you go? Edit that one out, buddy.
You don't care. We're okay.
My wife was there. I promise. Yeah, we. Man, I think I have to redo this. This is just. This is bad. Anyways. The Americans were awestruck by what's happening in the Canadian housing market. Let's put it that way. And, I had to explain these interest deferrals that are going on, and, people didn't have to pay their mortgages for 6 months. So anyways, but we're here now, and the Vancouver and Toronto housing market continues to push higher, really against all odds. It certainly has surprised myself this year, and I'm sure you guys on the podcast, but, looking through some of the Vancouver data, and Toronto data, which we got out this week. We'll get the national data, I think, a week and a half from now. But anyways, Vancouver wise, it's the same story, which is new listings came in at their lowest levels in 20 years. So outside of April of 2020, which was when the world was like literally shutting down and like people were like locked into their houses. It was the fewest number of listings for the month of April since 2003. Inventory is at all-time lows with data that we have going back to 2005. Sales are now picking up, still below sort of like longer-term 10-year averages. But basically what I suffice to say, essentially what's happening in the Vancouver market is prices 100% are pushing higher across all segments. And to me, it feels much more than a seasonal aberration. I think that this is 4 months now that this has been going on. And so I don't know. I think at 4 months, I'm prepared to call it a trend. I think that we are trending higher. And similar thing in the GTA. So if we look at the GTA, we had some data coming out here. You know, if you look at number of home sales, so if you seasonally adjust the home sales between March to April, sales jumped 27% on a seasonally adjusted basis. That's the biggest monthly increase over the past 2 decades. So sales activity is roaring back. Again, it's still below long-term averages, but that's as one would expect if you've got 20-year lows again in listings and inventory in the GTA. Naturally, you'd expect volumes are going to be lower, but prices have now been moving higher for 4 consecutive months in the GTA as well.
And I'll go first, Rich. Steve, what's happening with mortgage rates and financing?
You beat me. That was my question.
I knew. That's why I want to go ahead of you.
With financing, I honestly, things are like, I would say banks are like a little bit tighter, but like for the most part, like it's not that hard to get a mortgage. I don't think a whole lot's changed. I mean, it's obviously more challenging to qualify at a stress test of 7%, but your mortgage rates have basically been range bound since October, I'm going to say. Like we've pretty much been chopping sideways, give or take 20 or 30 basis points. We've been just, your 5-year mortgage rate has been about 4.8, 4.9 for the last 6+ months. And so, and like I said, we're seeing a lot of people going 3-year mortgage rates. That seems to be sort of the best priced mortgage out there. You can get a 3-year today at about 4.8. So you're seeing a lot of people go with this shorter duration term and obviously hope that mortgage rates are lower 2 to 3 years from now.
So walk me through. Let's just say Rich and I show up, in Kitsilano, knock on your door, and we have like a minimum down payment available to buy something. So walk us through what's the minimum that we can use, and what kind of monthly outflow would we need to buy something?
Well, I mean, I think obviously house in Kitsilano prime, your decent house, you're going to be $3 million. So it's a luxury market. So nobody's coming into like that market on like a local income that they've been saving for 15 years and they're putting down 20% and they're leveraging, 80% loan to value. Like nobody is doing that in that market. I would say it's very much like an equity rich market. And so people always ask, like the biggest, I think, misconception, at least in Vancouver and Toronto, which I would call global markets, where reality is you are dealing with people that are looking to come over here and park their cash. And 50% of the mortgages on that west side detached market are mortgage free. There's a lot of equity that's in the system. And so like, it's basically the people that are transacting in that market are they're wealthy people, or the parents are wealthy and they're handing their kids a large inheritance money basically. And that's really who's transacting in that market. So like, I know we always look at like price to income, like what can locals afford? It's like, the reality is like the locals, nobody's actually saving in my experience. I haven't seen people like, I've been saving for 15 years. Like you just don't see that.
And what about the rest of us?
Yeah, I mean, that's that. I think that is kind of like the sad reality, which is where the country is and where the housing market has reached these stratospheric levels. Is I think that you're out in the suburbs somewhere, you're relocating, you're going to Alberta, or you're renting. You're here and you're renting, and you're a high income earner, but you're renting.
Are you seeing the transaction volumes and the listings and stuff pick up in Calgary, which is a market relatively well, and or is it more of the same? Or
yeah, I mean, it's funny, the benchmark price in Calgary actually just hit an all-time high last month, so in April there. So that prices are still pushing higher there. Now keep in mind, like, that market basically went sideways for a decade. So while Vancouver and Toronto were ripping, like basically doubling in price, that Calgary market went sideways from about 2007 till about 2016, 17-ish. So it went sideways for a long time. So I think it's just, I know people go, oh, it's hitting new all-time highs, it must be a bubble. It's like, I don't share that view at all.
What about, like, what's the highest loan to value that someone can get?
If you're under $1 million, you can go up to 95% loan to value.
So it isn't, so 5% down, right? And that's CMHC.
CMHC, yeah. Federal government will basically insure your mortgage.
do you pay the insurance premiums, or does the federal government pay the insurance? Like, how does
you pay the insurance premium, so it does get tacked on.
So it's a clip on top of your mortgage.
Yes, correct. Yeah.
Okay, sorry, these are dumb. I just don't actually. These are,
they basically add the premium onto like your mortgage balance.
Okay.
So, but I mean, speaking of, CMHC, just, like, obviously the housing system's pretty broken here. We've talked about it quite a bit. Interestingly enough, we saw an article from Rosenberg out this week, basically denouncing what we've been talking about in the show. So maybe he's listening in, but talking about immigration and I'll just read you the quote here from Rosenberg.
So maybe just explain who David Rosenberg is.
I mean, I would call David Rosenberg I think one of the more respected or well-known economists in Canada. He was pretty famous. I guess he got famous for what, Keith, during the subprime crisis. I think he called the U.S. housing bubble relatively early.
He's had a lot of success. He's very well regarded in the industry. He's a Canadian boy. He was down in New York for a long time I think it was with Merrill Lynch. He was with
Merrill Lynch. Yeah.
And then, when Merrill blew up, then in 08, 09, everything disintegrated at Merrill. David then came back up to Canada, and he joined one of the larger old school Canadian buy side firms. He's with those guys for a while, and then he jumped out on his own. Maybe I'm thinking 2 years ago, maybe something like that. But he's been around a long time, and it's just an outstanding economist. Really great views, great conversationalist, and he's well respected. So that's who David Rosenberg is, or Rosie, as they call him.
Yeah, thank you for that. So I'll give you the quote here. So it says, this is from his note, Breakfast with Dave. I think he also wrote an op-ed in the Financial Post, but it says the BOC seems unlikely to raise rates again, which means the CMHC has to grow the stones to start to tighten mortgage credit and soften demand pressures through non-price rationing of available loans. Sorry, bankers. And Ottawa should seriously consider a less ambitious immigration policy, which is doing more harm than good at this point. A nation where folks in their 30s are crowded out of the housing market because of an elongated period of excessive home price inflation that is a result of federal government policy is not a very happy nation. And this will all come out in the wash at the next election. And if I were in opposition, this is the card I would be playing. Justin Trudeau aided and abetted among the most onerous housing affordability conditions the country has ever faced, with ill effects on society at large.
So he's going a bit more optimistic, it seems like, hearing that.
What? Sarcasm. Sorry.
I mean, yeah, it's a lot about what we've been talking about, but just to kind of like add to that point, and then we'll kind of wrap up the housing frontier and move on. But I wrote a piece on my Substack there last week, but talking about all the demand side stuff that we've tried to do to kind of cool this nation's housing market. I'll give you a quick list, and a lot of this pertains to the two large cities of Vancouver and Toronto. But over the last 5+ years, here's what we've done. We've done a foreign buyer tax, a mortgage stress test, a BC speculation tax, an empty homes tax in Vancouver and Toronto, rent controls in Vancouver and Toronto, expanded the mortgage stress test, increased the foreign buyer tax again. Then we created an outright foreign buyer ban. Then we increased interest rates by 400 basis points in 12 months. And then we created a new tax called the underutilized housing tax. And despite all of these policy measures, while I agree some of them might lack some teeth, housing prices across the country, for the most part, are back on the rise once again. This all leads me to the point of, I think that we need to start looking at the supply side. I'm not a huge supply side kind of guy. I think that I was always for the demand side, but we've definitely tried a couple policies. And so now it's about hitting the supply side, which, as we're seeing now, housing starts are rolling over. We're on pace for about 212,000 units this year, which is well down from 271,000 back in 2021. Obviously, as higher interest rates start to bite, the one thing, there was a really good research paper out this week from the Canadian Centre for Economic Analysis, to which they were able to derive that on a $940,000 new home in Ontario, you should expect to pay 288,000 of that 940 will be in taxes. So basically, essentially on $1 million home, you're looking at 30% of the price of new housing in Ontario is actually just taxes.
And then you're paying that after you've already paid whatever 50% of your marginal income in taxes. Right. And there's 15% sales to, anyway. Well, I just like to thank David Rosenberg for listening to the Loonie Hour. Because we were talking about this a year ago. And so there you go, boys. Every once in a while we get something right. And I think it's a shame, really. But we're watching this is going to come out in the wash. I think that's a very polite way of saying it. I think there's going to be an enormous backlash to this. And that's what David Rosenberg was alluding to. And I agree with him.
It's crazy, but like, that's the new housing supply is the highest taxed sector in Ontario. And it's crazy. But like, so you're taxing this, like, usually like, okay, we want more housing, but you're taxing it like cigarettes. And the logic would suggest that if you want more of something, you incentivize it generally through, like, what are we doing right now for EVs, right? We want more green electric vehicles. So we're bringing in all these like crazy rebates and giving Volkswagen a whole bunch of money. And then on the real estate side, like, well, it's interesting. I just think that, and this is why I continue to come back to, I think housing is completely broken. And it's just the system is broken, and it's not something that you can just reverse in 12 months.
Well, and like two things. First of all, you can make an argument that it has become a bit of an addiction
sure it has.
Tongue in cheek way. And even less importantly, the description you gave of Steve of all the new taxes and not taxes, sorry, the
demand side policies.
Yeah, the new policies to try to fix things. You must have rhymed off at least 6 or 7 of them. And all I'm thinking in my head, my God, we're turning into Europe. It sounds like a European fantasy land thing that's happening here. It's embarrassing. It's because any industry, you shouldn't. Let's put this another way. Government exists just to provide basic opportunities for the private sector to go out and do its thing. And, maybe that's right or wrong in some markets. Maybe I'm not introducing this correctly, but as soon as governments at all levels are starting to implement multiple new policies to try to address an imbalance, something's completely wrong, right? And, obviously that's the mess that we have here right now, not just in BC, but I'm sure it's elsewhere in GTA.
Well, again, it's a good point, Keith. And just to kind of round out this whole thing is you've introduced all these demand side levers to basically slow demand. Yet the one thing you did not slow was the immigration side, which has allowed a million people into the country in 2022. It's like, you can't make this stuff up. It's really just like unbelievable.
Keeps going back. I always like to break things down, really make it really simple. Is there a disease? Are you looking at the disease or the illness or the symptom? Right. And a really tight housing market is a symptom of something else that was established to create that. And and new policies that come on for everything, it seemingly seems like it's always you to treat the symptom. That's anyway, that's the world we're in here.
And I guess it gets back to the point of because people ask this question, like, well, if we start lowering taxes on, let's say, housing, because the governments have become addicted to it as well in terms of tax revenues, you got to generate those tax revenues from somewhere else. So where are you going to raise them? Are you going to raise them on income taxes? I mean, those are pretty high already. So it seems like the only way to...
I have an idea. You could spend less money. just throwing that out there. While I avoid the tomatoes from a certain portion of the population. I'm just saying you could just run smaller budget deficits.
Yeah. So what did we conclude recently, Rich, that the Canadian government at all levels is it 54% of the overall economy? Or was it higher?
Yeah, I mean, it depends on how you calculate it, et cetera, et cetera. But
public sector job growth?
No, public sector job growth has been out of control, but the gross, I mean, the total spending as a percentage of GDP. Sorry, Keith, you got me. I can't remember exactly the number, but it's very high.
Okay. Well, what else?
Anyway, there you go.
We got housing done.
There's your sad story for the week. Housing. Let's all forget about it. We're all screwed at the end of the day. That's good. Let's jump into the Fed, because I think that's like the big one here. I know our audience probably wants us to do a bit of a deep dive into that. So I don't know, you guys probably paid more attention to than I did, but obviously the Fed came out, raised rates 25 basis points, kind of as expected. The language certainly changed. In my opinion, my conclusion anyways, was that essentially, I think moving forward here, we're on pause from here on out. Not saying that, a pause does not mean a cut next month. I know the markets are pricing in a cut, I think as soon as September.
No, even earlier. Sorry to interrupt you, but even in by July, there's a 48.3% chance of a cut in July.
Sorry, Keith, I don't know if you want to chime in on that. That seems optimistic in my view, but you're a Fed watcher more so than I am.
I haven't even checked it here. Let's see.
Get that expensive Bloomberg machine running.
Yeah. No, Rich is right. By July, they're expecting a 25-point cut, and then another 25 in September. So, by January of 24, the market is pricing in 1.25 points knocked off.
Okay.
So then you have to say, well, yeah. Here. So let's go into it. I'll go second. Rich, you go ahead.
Oh, you bugger. I was well, I just think what I thought was a couple of really interesting was that in the statement, which was quite a short one, thank goodness, because I remember Janet Yellen used to go on and on and on in the monetary policies, the FOMC statement, which you can look up, everybody can see it. And Ben Bernanke's during the crisis, those were ridiculously long. But Powell, to his credit, is very short. But what I thought was really interesting is the first line of the second paragraph. It says, the U.S. banking system is sound and resilient. And I just think what I thought was interesting was, doth protest too much is what I would say about that. I mean, the reality is they're making an emphasis. Their emphasis on they have a dual mandate, so inflation and full employment. And the funny thing is, I think in some ways, I think that they've actually breached both of them. And so that's why I think that. So you could say, well, what's you could say, Rich, inflation PCE is still well above target. That's fine, but it is falling, even though I think it's going to be materially above target for a while. And then the dual mandate is, they're waiting, I think, for the labor market to break. And I think that that's basically going to force them into sort of a policy mistake. And that policy mistake is a function of the fact that the banking sector is under a lot of stress. And the reason it's under a lot of stress is because the inversion of the yield curve. So the short end of the yield curve is much, much higher than the long end of the yield curve, which basically destroys banks, basically. It doesn't necessarily destroy banks like JP Morgan, that have huge wealth management businesses. We'll talk about TD a little bit later. Or investment banking businesses that generate lots of revenue, but it does destroy the profitability of these regional banks. And that's sort of what we saw this week. Keith, you go now, and we'll jump back into it later. But that was my original original point. I thought it was interesting that they talked about the banks.
And just to add to that, Rich, would you not say there's like essentially a third mandate of financial stability?
Well, the joke was always the third mandate was the S&P 500. And I submit to you that not much has changed, that they target the S&P 500. But in that vein, the S&P 500 is at what, 4,100? So actually is actually pretty high given the stresses we've seen. The market's up like 6% this year. Tech, I've totally got this wrong. Tech is up like 18%. Banks obviously down 29% year to date. So, if that third mandate is live, then, those rate cuts are not coming. Keith, I don't know if you have something to add.
Yeah, I don't know where to start here. He had to make a comment about the banking system because, there's, a few banks are failing and things like that. So he had to do that. But to preface all this, I thought this was one of his best pressers that he's done in his career. I thought it was just outstanding. And so he had to come out, and he didn't spend a lot of time on it. He said, guys, listen, the banking sector or system, it's strong. Move on. We're not going to dwell on this. Because as you know, if he kept talking and talking about it, all of a sudden it's like, it is pretty bad. It is going to go down. So myself personally, I don't share nearly the same amount of pessimism or fear about the U.S. banking system as what is, being communicated sometimes. And I think people need to realize, understand as well, you cannot compare the U.S. banking system to any other banking system in the world. You cannot compare to the Canadian system or the European or Aussie or British or anything like that. The American banking system, it's incredibly complicated because you have like the shadow banking system attached to it as well. Like the private equity guys are out there. I think Apple, for example, I'm using this as an example. I may not be right with the numbers. They're probably the biggest money market investor in the world. I mean, their cash holdings, it's enormous. Like they're able to lend out more money than most regional banks themselves, for example. So we have a lot of this stuff going on. So he did come out with that, but we'll jump back over to the banking stuff in a minute. But overall, he was hawkish. I mean, he was not dovish at all. And he made two very specific comments. One was in general, he said, hey, rate cuts are not being considered, because that was one of the questions that came up. I think about cutting rates in June. He said, whoa. We are not cutting rates. That wasn't part of the conversation coming up. So he stopped that dead in his tracks. And then the other part, I thought was a great quote as well. He said that right now there's so much excess demand in the labor market. So if your mandate is to control inflation, which is all they can do is control demand, they can't control the supply side. They really want job losses. That's what they want, because that's what will cause the economy, to come off. And he's telling us again. He's very clear that, guys, the economy is still strong. There's lots of jobs available for people who want them and stuff like that. So I thought it was a very good meeting. I was quite happy with it. There was no wishy-washiness about it at all. And I thought markets reacted, appropriately. And then we'll go back into, I didn't realize, Rich and Steve, until you guys mentioned a few minutes ago, that rate cuts are being priced in going out. And after seeing that right now, I mean, that tells me, if rate cuts are coming, it's because there is a crisis. So maybe this does snowball a little bit further, what we have there. But what else do you have there, Rich?
Well, I was just going to say, I mean, the Fed, ahead, sorry. I was going to say the Fed never preemptively cuts rates. I think that's the sort of I don't know if that's the mistake or whatever. That's the sort of, I mean, I think that, if there really was a banking crisis, I think the Fed I mean, that's a big... Sorry, banking crisis is really strong. I think 2008 was a banking crisis. The entire banking system was undercapitalized. It was totally screwed. Now you have a situation where there's two sort of separate things going on. One is there's the large systemically important banks are actually undercapitalized. I saw a number, I'm not sure if this is right, but I saw like the top 25 banks or whatever have a loan to value ratio. So the amount of leverage, sort of like number of loans over loans over deposits, excuse me, I screwed that up. A loan to deposit ratio of less than 60, so 0.6. So that means they have an incredible amount of ability to absorb any kind of negative shocks that they have. But then you have a different part of the banking system. Remember, there's 4,200, 4,500 banks in the United States, and there's a bunch of these regional banks. And I think that those are the ones that are under a significant amount of pressure due to, obviously, their exposure to the real estate market, to the exposure to MBS, to the fact that they have to compete with the money markets at the offering 4 and 5% on whether and the fact that their loan books basically are being marked down as a function of yields going up. Right, when yields go up, bond prices go down, and so I think that there's so what I think that that's where maybe crisis is the wrong thing, but I think that the regional banks are under a lot of pressure, and I think that in order to deal with that, you need to have the yield curve flatten out. So you need to allow regional banks to make more money as opposed to no money whatsoever and bleeding money. And so that's where I think that's why I think, Keith, that the yield curve, that the Fed fund futures are pricing in cuts.
Yeah, Keith, to your point there, you're talking about Apple. They have a high interest savings account that yields over 4%, which is crazy.
There's a lot of cash out there. I sort of disagree with what Rich was framing there then, because the risk right now, there's a fear in the marketplace, in the banking sector, and you're absolutely right. It is very different than what happened 08, 09. That was a bad loan problem, right? Loans on the books were worth nearly as much as what people thought. What's happening today, it's the contagion, it's the fear. You're fearful of not getting your deposit back. So that's why money is leaving, the small and regional banks, and even the big guys are losing money. And I'd rather park in a money market. And so for people that may not realize what money market is, it's very short-term borrowings by very large entities. So let's just say Amazon, for example, they might borrow money for 30 days. So they borrow $50 million as an example. So that's a $50 million piece of commercial paper that matures in 30 days. Rich is running a money market fund. Like, he'll buy some of that. He knows 30 days from now, he'll get his money back because it's good credit. And he'll earn, 3.5%, 4%, something like that yield on it. Investors are more comfortable investing in a fund that is stuffed with these 30-day paper from companies and other structured entities, stuff like that, instead of having it on the balance sheet of a bank. And that's what's happening here right now. And I think was it last week or a week before, I forget. Remember we started talking about how when deposits are coming off the books of banks, it means there's less money available for lending. And we talked about, hey, we could get this credit crunch coming up here. And that's my fear right now. That's where we're going. The Fed did not talk about that at all, because in their mind, even Powell said, hey, I think we're going to have a real nice, cozy, soft landing. It's going to be great. The risk to that is that he's wrong. And it's because, the credit is not able to be extended through the system. But there are other ways to get credit, and that, like, big companies can get it and the smaller guys can't. But I don't know if that makes a bit more sense. Or did that confuse things more?
No, I mean, we've chatted about this before, right? Which is like you think about the regional banking system in the US. Obviously, it's much, much different than what we're used to here in Canada. But they are responsible for lending to a lot of small, medium businesses, including a lot of commercial real estate. Of course, we know commercial real estate to begin with, I think, is already under a lot of pressure. There's been very, very little transactions. We know what's happening in the office space, for example. Like, that's going to, I think what's going to be a pretty large restructuring. And obviously, just all these loans that are coming up for refinance or for renewal, you tack on the credit tightening from these regional banks, and you can just see this credit crunch that is likely coming down the pipe.
Yeah, and it's very different than, again, not that the banks have already made all these loans and they're going bad. What's happening is that there's been a lot of excess savings accumulated. And then people now are fearful they won't get that back. So it's coming out of the system. I'll give you two other stories from what I had this week. One guy I know who's pretty piped into that network, he said last Friday in commercial real estate, so we call it CRE, as we're looking at, Friday, the loan to value was 65%, a new issuance going out. And Monday, it was at 45%. And then by Tuesday, there were no deals being made.
How does that work? Can you walk us through that?
Yeah, so let's just say I wanted to borrow, it's your typical loan to value. So if I wanted to borrow, say, 100 million to build a shopping mall, say the shopping mall is going to cost 100 million. On Friday, I was able to borrow 65 million.
I see.
To build it. On Monday, I was only able to borrow 45 million. On Tuesday, I couldn't get a dime, like none. And that's liquidity, right? Like money just dried up immediately. And then I had another conversation with somebody I know, and they're involved with one of the larger firms. And, they said they had to roll over close to 2 billion a few weeks ago. And they were concerned if they were going to be able to borrow the full 2. And they were really concerned about what the price was going to be for it. In the end, they were able to borrow 3. So it was oversubscribed. So $3 billion came into this deal they offered. And it was at the same pricing they had from a few months earlier. So that's an example where, there's always good deals to be had. And like we're Global Macro, and that's what we do. But there are a lot of, bottom up equities, stock pickers and bond pickers. One of the best bond managers I know, very small guys. They're based offshore. They probably have $100 million fund that they manage, but it's just all bottom up stuff, right? And they find cool things to buy. But that's an example, there as well. And then the final thing for people to think about, say, well, how does that happen? How can they raise so much money? Just think about anyone who's in a pension plan of any kind. So say it's a defined benefit pension plan, or it's a defined contribution plan. So, every 2 weeks, your money's coming off your paycheck, or every month, and the company might match it and stuff. There's always money coming into the market, both on the equity and fixed income side. So like one of my good friends, he manages European credit with State Street over in London. And I said, okay, walk me through your day, or your week. How do you manage, European credit? And he says, Keith, it's pretty easy, actually. He said, I sit there and $25 million shows up, and I just call the brokers and see if they have any new issuance. And that's it. I said, do you ever have to sell something because you're worried about it? He said, no, there's always money coming in at maturity. We're getting our money back. And that's the life of the bond world, the fixed income world. It's not that hard, really, in some ways. And it's kind of disappointing when you hear that's how it works. Because they say, the bond guys are the smartest guys in the world. And some of them are, and some of them just sit at their desk. They wait for the email to pop up.
That sounds like a pretty good job.
It can be a good job.
Hey, but
unless the bond market explodes, then it's kind of uncomfortable.
Keith, you did bring up a good point on the commercial real estate side, just in terms of a loan to value perspective. So in the industry, we'll call these basically cash calls. I can give you examples. We're actually, I'm hearing this at least anecdotally in the Canadian housing space. So we talk a lot about supply, and we need to build more. And as we can see in the CMHC data that housing starts are rolling over. Well, a lot of this, again, to your point, is you are getting these cash calls because interest rates have gone up so much. For example, a developer that said initially was thinking, okay, I'm going to build this, condo building here, and I'm going to need to borrow $20 million from the bank to build it. Well, now the bank might only give you, 15 million to build it. And so you have to basically do a cash call to your investors. You have to basically go out and find that $5 million in equity to put into the deal. So a lot of these developers are having to put more equity into deals to make them financially feasible in the bank size. And so this is where we're seeing a lot of deals. It is, everyone's purses are a little bit tighter, right? So it's not necessarily that easy to go out and raise that $5 million. And so you're seeing a lot of these projects they are being canceled. They are being put on pause. And I think housing starts and construction is a very significant portion of the economy, particularly in the Canadian economy. So to your point regarding, loan to values, banks getting tight, I think that's where you're seeing more of the tightness in credit is on the commercial side. Like I said, on the residential side, and I'm not finding credit to be that tight.
I mean, like again, like talk about like the system is incredibly flexible, fluid. There's always the opportunist out there, and what you may not like that you have, somebody else will take it on. So an example of that was this week. The story was Ontario teachers. You probably saw that story floated out there. How
those guys have been in the news a lot.
Yeah, well, when you're that big, you're involved with a lot of things, right? But anyway, the story was like they were looking to buy some loan portfolios from the banks, and they didn't specify which banks and stuff like that. And so the question is like, why are the banks selling, and why are the teachers buying, right? And the answer is that they're both right. It's a classic trade where both sides can benefit from it. So let's just say, Rich, you're one of the big banks, and you got some smelly stuff in your loan book, from kids.
How dare you?
Yeah. And you want to get rid of it, right? I want to unload some of this stuff because you're just concerned about it. So as soon as you unload it, you get marked on it, whatever. But it then frees you up. It gives you more capacity to do other things, right? As opposed, like, for example, I'm pretty truthful and factual about the European banking system, because they never did unload all the bad loans, right? They weren't able to embrace new opportunities. They needed new private capital to come in to do that, and private capital wouldn't come in because of all the bad stuff that was still in the system. But if Rich, if you're able to sell some loans you're concerned about, that gives you new capacity to do whatever you want with them as a bank, because you want to optimize your profits and gains and minimize losses. Steve, you're the teacher's pension plan, and you don't have a quarterly time horizon. You're looking at multi-generational type investments. You're saying, yeah, I'll take that loan portfolio from you. We can absolutely weather 1, 2, 3 years of volatility in this. We don't even really have to market. And we think the marks on it are pretty fair with the price on it. So it's a win-win trade for both sides. And as well with pension funds as well, people don't realize it's not always the return that they're focused on. They're looking at the duration, because they want to match the assets with liabilities for payouts coming. But that's an example of where, hey, the market might be getting a bit funny out there. Banks, they might want to unload some bad loans, and there's a buyer out there, willing to take it.
Well, yeah, I mean. Rich, do you have any comments on that?
Well, I just want to, just if we could step back a tiny bit, I just want to say it's all a little bit circular. I mean, Keith used the word fluid and flexible, but it's also a little bit circular in a sense, because, the Fed is waiting for the labor market to capitulate. I'm of the view that the labor market is very, very strong. We've talked about demographics, we talked about skills mismatch, we talked about low population growth, et cetera. But, the banking sector is getting squeezed. And if you look at things like the senior loan officer survey, there's obviously credit standards are tightening. The demand is falling to a degree. Spreads are high. And so what you're basically seeing, and then that usually tends to lead some kind of credit creation number. The rub is that SMEs make up, so small and medium enterprises in America, in the UK, probably Canada too, make up something like 99% of all companies. That's not a very useful statistic. But what is a useful statistic is, depending on the jurisdiction, you employ something like 60 to 70% of all people in the workforce, excuse me. And so you have a situation where, like Keith has mentioned before, that those SMEs cannot go to bond markets and issue paper in the same ways that Apple or Microsoft or, Exxon or what have you. They go to the local bank or even the large banks and say, hi, we have these many assets. We have this much cash flows. Can we borrow? Can we open up a credit line for $50 million or $20 million or $100,000 or $5 million or whatever it is, to either build a new, that could be working capital. It could be operational. It could be OPEX. So, it could be just operational capital expenditure, or it could be brand new. I want to build a new building. So the trick is when you have a contraction or a tightening in that credit space from the banks, that can and does feed through into SMEs' willingness to engage new people, e.g. hiring new people or keep those people on board. And in the worst case scenario, as we've all witnessed, or most of us listening to this have been around, they contract their credit severely or just say, full stop, we're not going to lend. and companies eventually, SMEs are eventually forced to either slow down their operations and contract their operations, whereas a Microsoft or a large, let's say, a company trade on the S&P 500 can still go to the market and go to a pension fund and issue paper. And so I know it's a bit circular, but it's important. I think people understand sort of the flow through and the link between banking credit standards, spreads, tightening, all that stuff, and SMEs, and then back to the Fed, and back and around it goes. Sorry, I know, again, circular, but I think that's an important sort of little add-on.
So, Rich, Steve. That's a good point. Just to add to that, Keith, I'm kind of curious your thoughts here as well, because you said you were maybe like a little bit less concerned than what the narrative is out there. In the last couple of days, there's been some huge movements in some of these regional banks. I know that Powell was out saying everything's fine, nothing to worry about. But so you had Western Alliance, PacWest, First Horizon, all falling. So Western Alliance down as much as 62%, triggering volatility halts. PacWest down as much as 61%. The list goes on. And of course, First Horizon, which we'll get into, tumbled as much as 40% after saying TD Bank up here in Canada has agreed to terminate their merger, which was agreed upon, I think, in February of 2022, obviously at a much higher price.
What was the question?
How are you interpreting this? Are you concerned about the contagion that's clearly showing up in equity prices for these regional banks?
First of all, I just love the whole rhyme and of all the different banks getting hurt, and then you abruptly stopped. And
I was waiting for you to chime in.
It's not that many, I guess.
You're sleeping on the job.
Yeah, that's what happens when you hit 70s, guys. You need a nap every now and then. So a couple of things. So first of all, I like everything gets, put to the nth degree. When I said, I'm not worried about the U.S. banking system, it doesn't mean I'm saying, hey, run out and buy this stuff. Okay.
He's not worried about it. He's got all his money tied up in them.
No, I'm not a big investor in bank stocks. I think people know that. But there are concerns happening here, absolutely. And so one of the things I've talked about, and I've been very consistent with this, is, and it's it is what it is. But Canadians feel that Canadian banks are invincible. Like there are these amazing institutions that can always do this for years, decades on end, and they can never get hurt. So they're considered smarter, or for some reason they're superior to every other banking system in the world, right? So here's I'm just picking on TD because they're in the news right now. So over a year ago, they agreed to buy is it First Horizon Bank? I think it was
First Horizon.
Yeah, at 13 billion. That's what they valued at, right? 13 billion. And now this morning at open it was worth 8 billion. The company was, right? And the TD, correctly, they terminated the deal, right? That's what anybody would do, because you make a logical, efficient decision. Some people say, they got to pay a $250 million breakup fee, but yeah, that's a lot better than losing $5 or $6 billion in valuation. So it's hey, once again, Canadian banks are really smart, for doing that. However, these are the same banks. Okay, the same Canadian bank, as an example, that a year ago thought it was a fantastic idea to buy, a bank. So my point is that it gets circular sometimes with thinking. And I'm not saying that the banks are always awesome, because they're incredibly smart, complicated businesses to run. We've seen now, if you do not have a very good, risk strategy put in place, you can really trip over things. But the moment banks start to lose deposits, it's game over, right? And by losing deposits, it's a bank run. And that's what it is. In the old days, the bank run, people were lined up around the corner. Remember Northern Rock back in 08, 09? I keep referencing things from like 10 years ago. You guys are like, well,
you're so
mean. But anyway, bank runs don't happen like that anymore. People just go click, and the money comes flowing out, and it does become a bit of a contagion. So all these, Steve, the numbers you're just providing us, the decline in equity valuations for all these banks. It's happening. It's happening out there, and maybe it gets contained very quickly. But it doesn't mean that the system is wrong. It just means that deposits are shifting from one place, to another. And again, don't take that as a buy this or sell that. It's just an example that for any banking system, the moment confidence declines and you yank the money from the bank, then it's a real struggle. And right now it's happening in this this one corner of the biggest banking sector in the world, for the Americans.
Open the bank.
Open the bank.
Keith,
I
what
love
else?
bank stories. I got a ton of bank stories. Another interesting thing today.
Well, you were watching the Aussie Central Bank. I don't know if you want to get into that.
Just real briefly on that. So the Aussies, they were sort of late to the game in raising rates, and then they paused before everyone else. And then this past week, all of a sudden they raised rates again. So completely shocked everyone. There's not a lot of people, by the way, following the Aussie. There's not a lot of groupies for the Reserve Bank of Australia, unless you're over there. But they did shock the system when they did it. So the Aussie dollar immediately just went vertical up and stuff like that. And then naturally, that gets, hey, if the Aussies did it, that means, hey, the Canadians, maybe they'll raise rates again. And based on the information today, I suspect it's unlikely. That's what the Bank of Canada will do. And of course, as you know, like tomorrow, new data will come out, and next week, new data again. And, maybe that will, justify them to do something different. But the Australian story is different because they were really behind the curve relative to everyone else. So the interest rate differentials were widening. So, they did it. And then back here in Canada, does that mean the Bank of Canada are going to hike rates coming up next month? As of right now, like my Twinkie bet is it's no. I don't think they're raising. I don't know if Rich will say what they're going to do. I think Steve sees the same thing with me, that the
real estate guy sees no rate hikes ever.
Bad rate hikes, bad. But that was a bit of a story this week in that corner of the world.
There she was.
I wanted to add just a quick roundup on the ISM, if I may, because that was
get to the ISM, and then I think we'll kind of wrap it up. But because we've got as well something to keep an eye on is tomorrow, right? With the U.S. jobs reports coming out.
Yep, non-farm payrolls.
Again, Keith, when are we recording this? What day is it today? He's sleeping again.
Thursday.
Anyways, Rich,
we record on Thursday. Yeah, we should do a non-farm payroll Twinkie bet.
We could do. Let's do that. It's been a while. I
don't even know what the estimates are. This is not fair. You guys go first.
Okay, well, let me talk about the ISM while you look up at the estimates. And I think I'll be quick. I think what's interesting.
Okay, I have the estimates. Go ahead. Got it.
All right. So, ISM manufacturing PMI, the best diffusion index in the world, basically stopped falling. Now it's 47.1 in the US. And below 50, as we know here, and if you're a regular listener, is still in contractionary territory. Well, what was interesting is that it just stopped falling. I think it's always about direction and pace. A couple good points, I think, were the new orders and new export orders continued to trend higher, which I think is important. Employment also sort of jumped back above 50, so it's so basically now it's an expansionary territory, which I think was good. Again, it's still a negative. But I thought that was really important. One thing I thought was really interesting is prices paid. So a while ago, everyone was obsessed with this prices paid part of the diffusion index. So basically how much prices are going up or down. And then they obviously, they talk about that in the comments. And that's what I wanted to read. So it was just pricing pressures continue to plague daily operations after consecutive years of inflation and aggressive pricing. We are starting to see resistance and willingness to pass on to end consumers. So it's interesting that, pricing pressures are starting to rise, but the companies are less able to pass on those prices to their consumers. And so that to me flows into the margin story of a lot of these companies. We know that margins basically across the board are coming down. Obviously not necessarily the same for different sectors. So margins for tech companies, which are very, very, very high, have come down a lot. Margins for energy companies, for example, have gone up a lot. And then for consumer staples, they've been quite flat. But anyways, I thought that was sort of an interesting wrinkle. The thing that really shocked me, or didn't shock me, but that stood out on the services sector side, right? There's non-manufacturing, which is services, and there's manufacturing. So on the services sector, we got PMI rose to 51.9, but under the hood, I thought what was really interesting was the business activity. So in this diffusion index, you've got sort of the 10 different components and they aggregate them. And that's where I saw a continued downturn in the services sector. So remember, the services sector is the lion's share of the US economy. It's also same in Canada, same in Europe, et cetera. And that's where I thought was really interesting was the business activity component really, really fell down. And you say, Richard, how does that make sense? Well, some of the other components improved, but definitely there's some slowing there. And I just thought that was worth sharing with you guys and to give you an opportunity to make fun of me about using the diffusion index again. So there you go.
There she was.
The diffusion index.
All right, let's square this. Let's square this.
Okay.
Let's square this.
Yeah,
so here's
let's go here. Okay, so you need to know the estimate first, though. Before
hold on, let me open this thing up. So you had the JOLTS data came out a couple days ago, suggesting the number of available positions decreased for a third straight month. Essentially suggesting some weakness in the labor market. Now, Keith, as your question is, so Friday's job report, which comes out tomorrow, as of this recording, is currently forecast to show employers added 180,000 jobs in April. So apparently that's the estimate.
What was it last month?
Don't ask. Don't have a Bloomberg term.
Okay, I'll check quickly.
It was 236. So 236,000 last month. I think I won last month.
You did
this, yeah, because I'm pretty good with these things. I'll go. Do you want me to go first or last?
He's got an unfair advantage. He's got a Bloomberg terminal.
You won last time.
Tell you the future. Tell you the future. Okay, I'll go first. Okay, the estimate's at 180. I think the number is going to come in at 335.
Whoa. Okay. Huge. All right. I'll go first. Age before beauty, I guess, right, Steve? Okay, I'll say. Oh, that's screwed up. I think it'll be 227. Are we writing this down? Someone's got to write this down.
I'm writing it down.
Oh man. Okay, I'm gonna go 179.
I like it.
We are all over the place. We're like Stats Can's job numbers.
That's right.
Don't you love like market psychology here? So I just set the bar really high, and Rich is like, "Oh, I gotta catch up."
Yeah, you totally screwed me up. We got to do a blind. Well, it's interesting. So like one little. Oh, sorry. Go ahead.
This is a lot more important. So you guys follow the Babylon Bee? You guys do that?
Yeah, of course. Great Twitter
Steve?
Follow.
I don't know what that is.
It's just they just mock everything. That's what it is, and they do it a way that it looks real. Anyway, they had what's the American politician AOC? I don't know her.
Alexandra something Cortez.
Yeah. So they had her on The Price is Right. You know, The Price is Right. You have to guess what the price is of stuff, what it cost. And her answer for everything was free.
Rich, I think you guys, I'd love to see you and her on a date. Just
opposites attract. Who knows? Opposites attract.
You're not bad looking.
Man.
You know?
I mean, she's a very good speaker. I disagree with basically everything she has to say, but she's a very good orator.
You gotta have a spicy relationship, though.
You got to give credit where credit's due. She's a good speaker.
Okay, check out the Babylon
Bee coming around.
AOC on The Price is Right. It's really funny. It's good stuff.
AOC, if you're looking for a date.
Oh my goodness!
I think she's hit up the Tom Brady of macro.
She lives in New York, and she lives. That's right.
All right. Well, I think that's a good spot to wrap it up. As always, we appreciate your guys' support. Look for the jobs numbers. Whoever's listening to this probably already has them. So there you go. We'll find out who's right and who's wrong. Twinkie's on the line for next week, and we'll see you next week.